Great, so welcome back to this panel on banking regulation. Now we've rearranged the chairs. As you heard in the first panel, I'm Hannah Brenton. I'm a senior finance reporter at Politico, and I'll be taking questions throughout this session on Slido, so please do submit them. And with me on this panel, I have a great lineup of speakers. So to my left is Scott O'Malia, Chief Executive of the International Swaps and Derivatives Association, Baroness Bowles of Berkhamsted, a member of the Financial Services Regulation Committee in the House of Lords, David Pinto-Dushinsky, Labour MP for Hendon and Chair of the Financial Markets and Services All-Party Parliamentary Group, and last but not least, Mark Garnier, Conservative MP for Wyre Forest and Shadow Economic Secretary to the Treasury. So to kick off, we've had some kind of rocky moments in the last 5 years in the financial system. There was the dash for cash at the start of the pandemic, the fallout from the mini budget here in the UK, which both required central bank interventions to calm markets, and the 2023 banking crisis that brought down Silicon Valley Bank and Credit Suisse. So in this panel, we're going to be talking about some of the lessons from those moments, from those wobbles, what kind of regulatory agenda is still on the table, but also within the kind of bigger economic context of the search for growth and the arrival of President-elect Donald Trump in the White House. So to start off on the banking side, Scott, if I could ask you, one of the major pieces of financial reform since the crisis has been the Basel framework. Where does that stand and what does Trump's arrival mean for that?
Well, first of all, thank you very much for having us on the panel. Happy Thanksgiving to everyone out there. It is interesting to be between a reporter and 3 government officials. I do feel like the turkey dinner I'm about to cook. But let me respond to that question. We don't know what it means yet. We were on the verge in September. Michael Barr he is the vice chairman at the Federal Reserve, of putting forward the long-awaited Basel endgame. And he had promised significant reforms in this speech, vague, but pretty significant reforms. Now, the U.S. is the last one to go. Of course, one of the largest economies as well. So it's for all the marbles. We at ISDA are very focused on the trading book. And in there, we found a number of excessive increases in above Basel, and certainly above the UK and the EU counterparties of which we kind of benchmark things. The trading book is super important because it's a global trading market, and we really think about this in kind of a level playing field issue, and we really saw some real significant differences. And we don't know what the future is going to bring. We do expect some significant changes, and timetables are also a big change that we're certainly watching. Ideally, we would maintain a consistent global framework, a level playing field, and let firms compete, and making sure that we don't have a regulatory bias towards any one jurisdiction or nation. Some of the big things that we found problematic in the U.S. legislation, first and foremost, was the punishing treatment of clearing. Most U.S. interest rate products are cleared here, but that doesn't escape the clearing charges in the U.S. So at ISDA, we fought very hard to bring down the cost of clearing. Most importantly, what we want out of this is deep, liquid markets and risk-appropriate rules. I think as we go forward, you mentioned some of the crisis issues out there. All of these were liquidity events, right? We have put together a banking framework and a regulatory framework that is very focused on counterparty risk management. Now we have to deal with making sure that we haven't made the market too fragile and that we don't create episodes of liquidity in any jurisdiction. So what we'll be looking forward is rules that are risk appropriate, and we've done a lot of work to calculate that and what that looks like using quantitative impact studies and fed that back to regulators. We want deep liquid markets, and we want level playing field across jurisdictions. So, and timetables to sort that out as well. So if the U.S. is significantly delayed, the impacts here in the UK, certainly in the EU, that have already kind of put their cards on the table and put implementation timelines, we're going to want to see if we can adjust those to make sure that we implement in a consistent fashion.
So you'd want to delay in the UK if there is a
We will want to align them, Hannah. We don't delay anything.
Okay, Mark, if I can ask you to respond to that, is that something that you think the Bank of England should consider if there is significant changes on Basel in the US? What should kind of happen here in the UK?
Well, we haven't implemented Basel yet in the UK, and I don't think we're going to be implementing Basel 3.1 until 2026. So we're taking a bit of time to see that coming through. I mean, I suppose my take on this is that, and I agree with everything that Chris has said, but the world is becoming an increasingly complicated place, and we slightly arrogantly sort of tend to talk about the world as being what we see in the Western world. So we look to see what's happening in America. But I can remember, up until relatively recently, until we lost the election, I was the Prime Minister's trade envoy to Vietnam, and we were doing a lot of work trying to help Ho Chi Minh City become a financial services hub, not just for Vietnam, but for Indochina. And it was quite interesting because we were very much trying to make sure that we had the UK sort of common law and regulatory regime in place so we could make it easier for UK businesses to come out there. But actually, if you see areas like the Asia-Pacific Rim going on its own direction in terms of regulation and sort of led by China, then you can end up with two kind of different blocks across the world. And so we have to be sort of mindful of what's happening elsewhere in the world and whether that can preclude us from getting involved in it or can we persuade them to follow our way. But look, all the point about liquidity pools and resilience and all this, I think, is incredibly important. I suppose the final thing that I'd say is that we have to be very careful that what we don't have is a situation where compliance gets super expensive for everybody, which of course ultimately then goes on to the cost to consumers. And that in itself can hold back sort of growth amongst businesses who are trying to use this stuff. But I still come back to the fundamental point which I've always made about banking, is that banking is almost sort of socialistic. It is socialism in its purest form. It is taking money from where it's accumulated and delivering it to where it's needed. And that sort of very beneficial function that banking does is something which is incredibly important for economics and support of businesses growing who need to find cash. And that's why we need to get this absolutely right.
And do you think the UK has got that balance right on Basel at the moment?
I'll have to come back to you.
We'll have to see what the US
We'll have
puts
to see,
forward.
yeah.
It's a competitive market. We want to make sure that we don't, one jurisdiction doesn't gold plate or reduce their standards too much.
Yeah. David, do you feel the same? Is there a special place the UK can stand in this debate?
So it's really interesting, and I'd like to echo some of the points that we've heard here. There's a kind of national level and an international level. Nationally, our Basel 3.1 has been, relatively a story of consistency. So, in fact, the PRA's recent guidance, tweaked only a few things at the margin. They listened a bit to the industry on SMEs, on property valuation, on trading, on trade finance. But it only had a 1% impact on overall capital levels if fully implemented. I think the contrast is then with the international picture, where I think, to pick up the points that Mark and Scott have seen, I think we're seeing a potential risk of real fragmentation. So the centrifugal forces are really quite powerful here. We've seen it in the Basel endgame U-turn even prior to the election of the new administration, which I think has quite profound effects. I mean, it didn't just halve the capital requirements, it's also critically, and I think especially for the appreciation of US banking, move the threshold for who's actually covered by the full fat Basel rules from 50 billion of assets to 250 billion. That's a huge move, and that essentially will take quite a lot of the US banking sector out with some of the core of Basel. We also saw their big changes on op risk, which I think will again make a huge difference to some banks, but could lead to a real divergence of paths. And so I think we're going to see this, I think the risk is for potentially quite a lot of centrifugalism, one. And two, to kind of pick up on Mark's point, I think there's a lot more politics with a small p that will come to the fore. So already we see discussions with US regulators where they are concerned about institutions' exposures to China. And I think as we get more politics, more of the politics of quote-unquote national champion banking, I think that will also have an effect. So I suppose the question, I think Britain is absolutely, doing the right thing in terms of trying to reflect the core, I think sticking quite close to the Basel, the spirit of the Basel Committee's recommendations. I suppose the other thing I'd flag, and it came out in the Mansion House speech, as Rachel talked about a reset with Europe. The other thing, obviously, we're trying to do is not just work out where the States is, but how we keep the right relationship of equivalency and convergence with kind of Europe. And so maybe we'll see a bit more of that, but I'd be tempted tempted to echo Mark's view that I think we need to slightly watch this space, because the core message here is one of uncertainty.
Mm-hmm. Sharon, do you agree with that? You worked in the EU for a long time, so do you see a risk of more kind of fragmentation on these kind of global standards?
Well, that might be the case if the US decides to be an outlier. And I mean, in some ways, they have been a little bit compared with the EU and the UK on some issues, but there are other ways that they've aligned. But I'm more interested in some ways in the things that we're doing at home, where we're shooting ourselves in the foot already, where we are, it's the gold plating. And one of those issues is MREL, where we introduce MREL when banks are at the size of 15 to 25 billion, whereas in the US it's $100 billion, and in the EU it's 100 billion euros. And the effect of this is that once you get to a reasonable size, the size of something like Paragon Bank, they have to sit there and think, well, are we going to go in for this sort of super expensive MREL, because it's very expensive when you're a smallish bank to do it? Are we going to grow and get captured, or are we actually going to stay at this smaller size? So the effect of that is we are just not getting new mid-sized banks, just the kind of banks that would want to be lending to businesses that might be regional and know more about their area. So the very first thing, if you get on the growth agenda, is, well, we have to look at this, because otherwise you're not going to get the money going into where you want it to help the growth agenda amongst the business community. And I just cannot understand why there isn't a huge political noise about this, and why there hasn't been. The fact that you cannot criticise the Bank of England, and that there really are very few ways in which you can influence it, to my mind, has actually gone too far. And I think that came out when we were discussing the recent bank resolution bill as well. We wanted some quite mild little things, to know how things were going to work out. We managed to get some reporting back, right at the end when it's all finished, but they don't even want to think about anything else other than the problem that is there, and say, therefore, you can't be accountable for anything. You move into that kind of area as well, where you're looking at bank resolution, where we're now going to be using private funds instead of public funds for a public interest point, and you've no extra, are you sure this right check, then that worries me.
So for anyone who doesn't know, MREL is loss absorbing capital as well. But so do you think, particularly with the bank resolution bill in mind, that was brought forward as a response to some of the bank failures last year, and Silicon Valley Bank in particular? Do you think that means we're not learning the right lessons by bringing forward that bill?
Well, I think that the bill, it was a bright idea that with Silicon Valley Bank, which we should remind ourselves that one of the reasons we actually want uniformity in how we apply Basel is we want to also minimise contagion. So we had a touch of contagion there, and then it was rescued using public money. Now, if it had gone into resolution, it would have triggered the Financial Services Compensation Scheme for deposits up to 85,000. And so the bright idea is, well, actually, the Financial Services Compensation Scheme hasn't had to pay out. So if we come across a similar situation again, and it's decided that it's in the public interest to save it rather than to go what they thought was going to be the normal route of bankruptcy and dissolution. If you're going to go down the route of saving it, then use the financial services compensation scheme as a pot of money, and then that, of course, has to be topped up by all the other banks. So you've got this rather strange scenario now where the banking sector has to pay a levy in order to bail out its competitors, which is where I'm saying we're now using private money to bail out in the public interest instead of public money. And, we just felt that there weren't enough handles over that. So it was a good idea, but it's also showing that we're now thinking much more that resolution is going to be what is happening. From the Parliament side, well, we actually amended it. I mean, all of us on the opposition benches and the cross-benchers, we all thought that it should be limited to small banks, and we put an amendment in to that effect, because otherwise, is MREL, this expensive MREL, ever actually going to be used? And we became, concerned that that was the case. And I think it opened a lot of questions about what do we really think is going to happen, and have we made the right choices historically?
Yeah, so this bill now heads to the Commons. So, David, do you share those concerns about the right choices?
I've got to admit, I take a quite different view. So let's step back and start with kind of the Mansion House speech. We've talked about moving from an area where we regulate more for risk to where we regulate more for growth, and Rachel's talked about having the most pro-growth package of measures since the global financial crisis. What has to come along with that is a sense that we don't create asymmetries and moral hazard. And so where I suppose I disagree with Baroness Bowles is that clearly, and I'm very scarred, so I'm not just a chair of the APPG, I worked for many years for Standard Chartered Bank as a managing director, sitting on their African management team, heading up parts of group strategy. I was also an advisor to the Chancellor during the global financial crisis. And one of the problems we faced was this asymmetry of private risk, but public money when it goes wrong. And so, part of the foundations of creating a safe, kind of safe environment in which we can incentivize growth more is making sure incentives are aligned. So point one, I think that is right, that banks bear their own risk rather than laying it off to the public purse. Point one. I suppose point two, for me, the really interesting lesson of Silicon Valley Bank, which is why I think these measures are so important, is that when I actually look at what happened in SVB, at Signature also, at Credit Suisse, I think one observation and then three conclusions. My observation was in many ways these are very traditional bank failures, right? We see massive failures of governance. We see failures of risk management. And so it's not due to lack of capitalization. It's classical bad running a bank and it not being and it not being governed properly. In the case of all three of them, to lesser grade to extent. And when I look at the regulatory responses, I think Britain actually did really well. SVB here was small enough that it could have just gone through bank insolvency procedures, but the regulator was fleet of foot, and actually halfway through the weekend worked out that would have added to contagion risk. So they shifted to shifting accounts. Contrast that with what the Fed did. If I want to go to the root causes of the SVB failure, and by the way, the Fed's held their hands up in the official report, the bank was below the threshold for full kind of Basel III full fat gold-plated regulation, but expanded massively. And yet the Fed didn't adjust their approach, even when it was clearly bulking up on steroids. So for me, big lesson one is regulators need to be flexible and need the tools for that. Lesson two is that they also need to have the capability to do basic regulation of governance. And so some of this is being good at the basics. And I think the bill helps with both of those things. I would say one final thing, though, which is, for me, in some ways, the most interesting failure was the Signature Bank one. Because although traditional and they had too many crypto assets and clearly didn't know how to manage them, it was also a flash crash. Right? The combination of Twitter plus banking apps meant that you had a run in hours rather than the runs we saw in 2008, which were horrible but took some time to emerge. And so again, this again comes back to, so therefore regulators need flexible tools to move fast. And I think the Banking Resolution Bill really helps with that.
So that brings us to a question from the audience that's on a very similar note. So from Simon Hills at UK Finance, do you see bank failures as regulatory shortcomings or supervisory lapses? So Mark, if I could get you to weigh in, do we need more regulation or better supervision? Or
It's a really strange one. I spent 3.5 years on the Parliamentary Commission for Banking Standards, and we were going through a whole load of kind of this in absolute minute detail, and the Treasury Select Committee scrutinising FSMA 2012. And there's just listening to this sort of conversation, I sort of kind of go back to the first principles, and sometimes we can get caught up in tactics when actually we're trying to work out what the grand strategy is and all of this sort of stuff. And I think, David, the point you make about regulatory flexibility, I think, is incredibly important. But ultimately, life is risky, and we've got to be able to sort of understand what is just risk that is going to be inherent in a system, and risk that is stupid and we should be able to rule out. And it's one of these very, very complicated problems. Is it how do you try to have acceptable risk, and then at the same time educate people about what that risk is? Because ultimately, we cannot immunise everybody from every single problem that can possibly happen, be it a banking system or from a global pandemic, from COVID or whatever. So we have to try and work out what it is we're trying to achieve. And I think it comes down to those fundamental points of, are we going to isolate contagion? So we've looked at things like ring fencing and all that kind of stuff. And again, I come back to the Banking Commission. There was a whole load of stuff which we brought in, which we're not entirely certain was the right thing. And one of the early failures of that was the reversal of the burden of proof. Where if a bank failed, it was assumed that you had got it wrong as a manager, and therefore you should be held guilty of it. In the end, it was just you can get around that with a compliance pro forma way of dealing with it, and it never really kind of properly worked. So I think we do have to keep modifying these things, but we have to keep coming back to this grand strategy. We have to accept that there is going to be risk in banking systems. We have to accept that we're not going to let it spread. We've got to have regulators who are actually sensitive to the need to be flexible and all this kind of stuff, and make sure that they aren't falling into that trap of any institution, which places as its first duty of keeping itself in existence and its second duty of delivering whatever it is it's meant to be delivering. And I think that we need to make sure that when we bring about the growth agenda and the international competitiveness agenda and this stuff, which is very good stuff in the Mansion House speech, that it gets built into the way the regulator works and isn't something which they pay lip service to and then keep drifting back. So it comes down to things like the Treasury Select Committee, making sure that the long-term objectives are being maintained. And as I say, that comes back to grand strategy versus tactics, and we could get bogged down in the tactics and miss out on what the grand strategy is.
In that sense, in the grand strategy sense, do you think that the message from the government has been very clear to kind of encourage more risk-taking? Do you think that do you agree with that message? And is there a sense that financial rules in general have gone too far since the financial crisis?
I think I think some of them are very good, and I think sort of the micro detail, as Sharon was talking about a little bit earlier, about these caps of where you set the sort of transition from one set of rules to another. If you over-egg the pudding, then you end up stifling things domestically. So you have to be very, very careful. Look, I think the general sense I'm getting back from the city is that people are very happy, welcoming cautiously what's being said. And my view on all of this is that I think I'm aligned with Rachel Reeves at the moment, but we absolutely need to see more details about what's coming down the way, and then we can sort of go into the fine details, coming back to that tactics versus strategy thing, to make sure those tactics are the right thing. But yes, when it comes to accepting that risk has got to be there, then yes, I agree with her. But I think with that comes a requirement to make sure that people understand what risk is, and that if things do go wrong, to a certain extent, you are going to be, possibly be hit by that, and to understand what that means. Obviously, that means that you've then got to make sure you balance that with people then not being prepared to take any risk at all because they're worried that you're introducing other risks elsewhere. So it's going to be sort of complicated in terms of little spider's web going on. But yeah, look, as I say, we are looking at what Rachel Reeves has said with the Mansion House speech and all the rest of it, and we welcome that direction of travel, but we've got to be able to be satisfied that the detail is delivers that strategy.
Okay, before we move on to talk a little bit more about non-banks, there's another question from the audience on the Basel Committee from Orestes Nikou at Deutsche Bank. With all the focus on competitiveness in the UK and the EU, let alone the US, is there a future for global standard setters like the Basel Committee? And somebody else asks, will the endgame actually ever be implemented? So I guess those bigger questions about the direction of travel on global standards, where are we heading?
We have to use the Basel Committee. It's essential to have these aligned and have regulators in a convened environment discuss the trade-offs. All the points made on this panel today, what is the trade-off between safety and soundness, economic development, safe liquid markets, and trying to figure that out. Spotting new issues is critically important. We'll probably get into this overly egged non-bank financial intermediation term that people are using, but I think the Basel Committee serves an important role. And in fact, once we do get this, and I do think that the Basel endgame, I've got to believe it, will play out in the US eventually. Once we do have that, we need to begin to say, did we get it right? Right? Are there areas where we need to sand off some rough edges? Do we need to fix some things? We have to have good alignment on clearing. Clearing is a safety tool that we must have a robust safety device around that, and we have to have global recognition around that. And I think that's an area that we still are fighting through in the EMIR rules. We also have to make sure we think about risk in an appropriate way, and have we overdone it on internal model application. And I think that ought to be revisited, if not rolled back, to make sure that we serve what regulators are concerned about, the opacity of the models, but at the same time ensuring that we have good, proper risk management going forward. So there are a couple of big issues that we're looking at in those areas to make sure that we do have consistent global alignment and a safe system.
But you think the global rules are still coming, though?
I do. Yeah.
Does everybody else agree with that, or do you think there's more of a chance it might not happen?
I think that they've proved their worth, really, because you go back to the financial crisis in 2008. That is a long time ago, and in the normal cycle of things, where regulators tighten and then it gets looser, that's more normally been 5 years or something like that, and that hasn't happened because there has been this international alignment. So we actually have had this period of stability, and therefore I don't really think that we're going to want to let go of that, wherever we are, and the introduction of central clearing and other things has been a big part of that. So we've stopped this swinging pendulum, and I don't think anybody wants to bring it back. So they're here to stay, in my view.
Yes. David?
No, and very much to build on that. If you just to take one example, which is of increasing in importance here around sustainable finance. Currently, I think I'm right in saying there are 60 separate taxonomies, which is actually impeding the creation and growth of the market. And that gives you just an example of the route you start going down if you don't have some kinds of global standards. So I think we all have a very strong vested interest in ensuring those. I suppose the question will be on their scope. I also agree with Scott. I think it will land. I'm really struck. I have a slight sense of deja vu in the sense that when I was at Stand Chart, I was in a room just like this, on this street, on a cold November day, and we were talking about the fact that, oh gosh, Basel III may not be fully done till 2019, and it had been pushed out. So we're now looking at 2026 with, although Europe probably a year earlier. But I think we will get there, I suppose. But there is a bit of a question about will it be quite as all-encompassing as once was? And I think part of that global discussion also needs to be on what's absolutely essential to have convergence on, versus what bits are going to more reflect national stuff. And when I look at the difference between even our markets and, say, European ones, and the kind of slightly overbanked nature of Europe and the way their markets are far more bank-led, you can see there might be, there might be less convergence than was once hoped, but I think they're absolutely essential, and I think they will happen.
Okay, I think that brings us quite nicely to the non-banking side, because that has been an area where there's been a lot of global regulatory focus, and there's work going on at the Financial Stability Board on leverage. And actually tomorrow we also have the results of the Bank of England's first kind of major stress test of non-banking, so it is both national and global. So do you think there is, in this debate about where global standards are heading, is that an area where there is still going to be that focus, or is there a risk that none of this really is going to happen now? Scott.
I have some frustration with this grand characterization of non-bank financial or shadow banking. First of all, this is not a monolithic industry, right? This is, you've got hedge funds, you've got pension funds, you've got insurance funds, you've got private equity, all doing different strategies. They're not investing in the same way. They're not all behaving the same way. So to characterize them grandly or in one bucket is inappropriate, and you kind of miss what's really going on here from a risk basis, and we need to think about that. I think what we need to go back to as first principles is look at the data, right? We've been reporting data in all markets in an not an excessive amount, but there is no lack of data that's being reported to policymakers and regulators. Look through that data. Tell us what you find in terms of risk and exposure. Work through that first before you ask for more data, because this is an expensive tool.
That's what the Bank of England's going to do tomorrow, though, isn't it?
Fantastic. We'll take a look at that. The next bit is, as we think about, is have the tools we've implemented done their job. So we've already been talking quite a bit about bank safety and soundness through the Basel Committee and those rules, which have increased before we're about to get to the new implementation in 2026 and beyond. There's also the non-cleared and the cleared rules, right? That has had, in non-cleared alone, we've added over $1 billion, $1 trillion, half a billion in clearing, more than half a billion in clearing alone, or 500 billion, sorry, half a trillion in clearing alone. Mm-hmm. So we have a lot more safety and soundness around all of these participants. What impact does that have? We've had an exhaustive look at both the non-cleared and the cleared rules. Is procyclicality a feature or a flaw? We believe it's a feature because it makes clearing accessible. The non-cleared rules have been very stable and resilient, and we've tested it through some of the examples that you said. So before we start reinventing the financial regulatory architecture, let's make sure that we're looking at, are the rules working today? Have they been resilient in these things? So I think all of that evidence is going to kind of point to yes, it is working, and let's maybe calm down a little bit before we start developing a new set of regulatory framework.
Okay. David, do you agree with that? It kind of need to take stock first, or are there issues that really need to be addressed straight away?
So look, firstly, I wouldn't claim to have deep expertise on this. I suppose I'm struck by a couple of things, and by the way, I don't speak for the government. This is very much me speaking for myself. When I look back at some of these markets, one, of course, we want more capital invested in Britain. We want deeper, more liquid markets, and to an extent, we're somewhat agnostic as to where that capital comes from. Equally, I am struck by what happened in LDI. And at a 30,000-foot level, as a layman, I could say what's really interesting about what happened with LDI is that the story really echoes what happens in banks in 2008. You have funds that don't really carry enough buffer, that haven't really understood the degree of volatility and risk, because we did have an extreme risk, extreme volatility event in the movement of gilts, and hadn't really understood the degree to which counterparty risk can become liquidity risk, and liquidity risk can become solvency risk, right? Now, those sound very much like the lessons of 2008, and so I could say, isn't it interesting that market participants were still relatively slow to learn them? Point one. Point two was obviously, look, without getting too party political, obviously, we know the role of the mini budget, but leaving aside the really poorly thought through decisions of that budget that caused havoc for our economy, it also all happened at the same time as quantitative tightening. So the lack of policy coordination was catastrophic. And so both of those things for me point towards, yes, you don't want to overregulate, but you do need some kind of framework to make sure lessons are being learned and these things are being watched. I would say one also final thing, which is all of this does point to a third lesson, and again, not being party political, which is you cannot separate the macroprudential from the macroeconomic and the governance. The fact was, in the last 8 years, Britain had 5 prime ministers and 7 chancellors. In the last 14 years, we had 11 city ministers, half of whom only served less than a year, right? That itself is not the basis for macroprudential stability. So I think, yes, I personally think there are lessons to be learnt there, but you need to get that broader framework of stability right, and that's absolutely what we're trying to do, as a new Labour government.
Mark, do you think the right lessons have been learnt from the LDI crisis?
Look, David, you're being incredibly polite. I mean, I'm a Conservative member of Parliament. Let's not beat about the bush. That was a bonkers budget, and I think the important point about it is, look, your points are absolutely right. I agree with you 100%. And What was extraordinary about that? I can remember just after we had got rid of Liz Truss, I was in Singapore a week later with the International Trade Select Committee, talking to investors and about the UK. And this is the point I'd make to everybody. Actually, we had a disaster. I mean, it was appalling what happened with that budget, and she went against a whole lot of the standard rules which you should have had. Every chancellor should run their own budget, and she took control of it. Every prime minister should listen to the advisors, and she ignored all the advisors. But what was very encouraging about the UK then was the political system healed this very, very deep wound very quickly. And it took 2 or 3 weeks before we finally got rid of the cause of this problem. And let's not beat about the bush. I mean, and it's been a problem for us subsequently, as we saw at the last election. But the system kind of worked. But look, you're absolutely right. I mean, at the end of the day, you've got a lot of different things that are coming together. So you've got the Bank of England, which is independent. I mean, it's legislated to be independent. So quantitative easing or quantitative tightening or whatever, because it turned into quantitative easing straight after that problem erupted, it came there and did it. But it's got to be independent, because if it isn't independent, then how are you going to have this sort of, what Gordon Brown brought in when he gave that independence was a very good thing. And we don't want to change that, because if you keep changing things, you lose confidence in the system. So there's that problem. You've got to have politicians who understand how the system works. And when you were an advisor to the Chancellor, as you were saying you were, if the Chancellor can take your advice or ignore it, but they've got to listen to it. And that was the problem we had with that mini budget. So as long as the politicians are playing the game properly, then that's absolutely fine. And then the other thing about learning lessons from history, so we talk about learning lessons from the 2008 banking crisis, and we then sort of subsequently see other problems coming through later. And actually, all the reforms, the banking reform, FSMA and 2012 and the Banking Reform Act, were all about sort of basically having sort of insulating the system so that you didn't have contagion across it. But it was rather like kind of the Titanic in terms of trying to make sure that you have watertight doors. It doesn't always work. But what we didn't do was learn the lessons from the Asian banking crisis in 1998. And the Asian banking crisis was where you had a huge amount of money being lent to the property market at very, very high, also very big ratios. And as a result, when the property market came down, the banks got nervous about understanding what the price of property was. So they kind of prevented people from selling property until this thing compounded and compounded and compounded itself. And then wind forward 10 years. And we had a system where you had these derivatives, where there was this wonderful analogy of what was going on. It was the Gillian Tett, I think, from the Financial Times, who talked about a butcher, and if a butcher finds a green pork chop on their counter, they can do one of three things with it. They can throw it away. They can take a punt and take it home and eat it themselves. Or the third thing they can do, which is what you shouldn't do, and what did happen in the banks, is you chop it up with all the other good pork and then put it into a whole lot of pork sausages and sell it to everybody through these derivatives. And the result was the contagion spread through the system through these derivatives. And yet we had the fundamental cause of it, which was bad mortgage loans, we hadn't learned from the banking crisis in Asia 10 years earlier. So absolutely, the lessons of history are incredibly important, and we really must sort of understand that. And I can bet your bottom dollar in 10 years' time, we'll be looking at another banking crisis that we won't have learnt from LDI. So something will happen, and we haven't quite picked it up. So ultimately, this is why I come back to this point about the grand strategy, not the tactics. We can get bogged down in what has happened today and try and work out how we can sort the problems out tomorrow, or we can try and understand what the really big picture is, and make sure that those fundamental kind of tactical flaws don't create contagion, which is why you need to introduce this risk element to allow banks to fail, to allow there to be a cost, potentially to consumers. I mean, I wouldn't want it to happen, and I wouldn't want banks to fail, but people have got to understand that you cannot be kept immune from all risk completely. And then you have consumers beginning to understand that risk, and then beginning to to not kind of deposit their money with banks. Where, of course, you're an investor, you're part of the balance sheet. And that's the other thing people don't quite understand is when you put your money in a bank, you are a bit of the balance sheet, not somebody who's got a shoebox with your £50 note kept under the counter. So it's all of this kind of stuff which we need to educate.
Yeah.
Educate people.
Can I just ask quickly, is it the formal position of the Conservative Party that it was a bonkers budget now?
I think it's the informal position of all of us who are left.
Sharon, you wanted to comment?
Well, I think that there's so many things you can learn about LDI. You can point to it and say there's a repetition of the mistakes that have happened in banking and other things before. But one of the mistakes that was happening there was that there was, if you like, regulatory interference in order to encourage pension funds to hold a lot of gilts at a time when the returns were very low, and then they had to try and find ways to increase the returns. And so then, although technically they're not allowed to borrow, they decided that it wasn't borrowing to do sort of repeated repoing, and therefore got themselves into this position that they didn't have enough liquid collateral to cope with the sort of event that happened as a result of the mini budget. But the lesson we have to learn from that is, we're now looking at pension funds and saying we want to some extent, mandate a little bit more about the kind of things that they're investing in, whether it's going to be UK infrastructure or whatever. And we have to be prepared for the downsides of that if we've got lots of bigger, I know this goes on to your next session as well, but if you've got these bigger funds and you're going to have ways in which means they're going to look very similar in the types of things that they're investing in, then the risk of some kind of contagious effect happening and it all going the same way becomes higher. I'm not saying we shouldn't do it, but we have to take account of that fact.
Okay, so contagion still very much a possibility. Unfortunately, that is all we have time for, but thank you so much to all the panellists for a really interesting discussion, and hopefully we covered quite a broad stretch of financial stability issues. So the next panel is Unlocking Investment in the UK Economy, moderated by Fiona Maxwell, so do stick around, and thank you again for all of those points.
Thank you.